Okay, good afternoon, everybody. Thank you so much for joining us today for our webinar on financial independence and planning. We have a fantastic speaker here with us today. His name is David Harris, and I want to tell you a little bit about him before I turn it over to him. David serves as the Director of Retirement for Gwinnett County Public Schools, providing administration for a $2.3 billion defined benefit pension plan covering 35,000 members in the school district's 403B, 457B defined contribution plans with over $700 million in assets. Prior to accepting this role in 2018, David spent over 25 years as a pension actuary for some of the nation's largest actuarial firms, maintaining a focus on the sustainability of public defined benefit plans across the Southeast. Besides consulting to several public plans in Georgia, David has also been a featured speaker on actuarial and administrative topics at Georgia Association of Public Pension Trustees, Florida Public Pension Trustees Association, Opal Group, and the Southeast Institutional Forum. David has also provided cost analysis and opinion on several pension bills presented to the Georgia State Legislature. David lives in Atlanta since 1973, has been married for 28 years, has 2 sons, 2 dogs, and enjoys tennis, running, cycling, and weekends at Lake Hartwell. He earned his degree in mathematics from Florida State University, and he has a master's in actuarial science from Georgia State University. So needless to say, David has lots of wonderful experience. So if you have any questions throughout his presentation, please feel free to put it in the chat. We're going to try and answer as many of those as we can at the end of his presentation. And then any questions that we don't get to, we plan to, this session's being recorded. We'll download those questions, get those answered, and get those posted so you can check back and get the answers to your questions. So I will go ahead and turn it over to David. Thank you.
All right. Thank you, Karen, for that nice introduction. Well, I guess one extra thing to add to this that I have to add to all of my presentations. I am not a financial advisor. I am not trying to sell you or get you to purchase any particular products. My goal is just to provide some general education about retirement planning and basically encourage you to seek out your own financial advisor who can advise you and your spouse and your family about what best fits your needs in your career. So everything throughout this presentation is going to be my opinion based on my experience working on retirement plans and programs over the past 30 years. There we go. So the topics for today, basically the biggest one, saving for retirement. I want to teach all of y'all how to become millionaires. That seems to be the most important part that everybody likes to know in that process. Obviously, the reason everybody wants to work, one of the reasons to work is to eventually not to work anymore. And these are to give you some goals and how you can achieve that. Additionally, we will touch on some of the programs that you have to your use to be able to accomplish that, such as Social Security, the teacher's retirement system, the public school employees retirement system for those who may be involved in those or used to be involved in those. And then also your defined contribution plan, such as a 403B and a 457 program as well. The main thing I want you to get from this presentation, I want you to basically leave this presentation with 2 important numbers that I want you to remember. The first number, obviously, is a range of 10 to 15%. This is the general benchmark that people should be saving from their paychecks throughout their entire working careers towards some type of retirement program in the process. By doing that, you have set yourself on the journey to get to a comfortable retirement. And a comfortable retirement for the benchmark out there is basically to get to a point in your career where you'll be able to replace about 80% of your income with retirement benefits. That should give you roughly the same standard of living in retirement as that you were enjoying while you were actively working. Now that 80% benchmark is kind of created by the fact that throughout the course of a person's career, they are generally using a lot of their expendable income to raise a family. to support their children, to pay off a mortgage to a house. And a lot of those expenses, hopefully, and obligations have disappeared by the time a person makes a retirement decision. So when you hear people talking about being able to retire with less money, those are usually the main reasons behind that, is that they are now becoming more selfish and spending more of their disposable income on themselves as opposed to their children, or necessarily having to pay off a mortgage to a house. Want to start off one of these conversations and just kind of giving a brief overcap of what people generally see in their paychecks, because this is important when we start talking, or when I start talking about what expendable income is. Years ago, if your parents gave you $1,500, you had $1,500 to spend. However, if your employer gives you $1,500, you don't have $1,500 to spend. And here's the reasons why in the process. First, your employer is required to take out money for Social Security and Medicare. So those are the FICA and Medicare deductions that you'll see on your paycheck, going to Social Security and Medicare coverage. You're obviously having federal taxes taken out of your paycheck. Those taxes are going to support our military, to support Medicare, support the building of our interstates, to support programs such as free food at schools. There are state benefits that are probably being, or state taxes being taken out of your paycheck as well. Those taxes are being used by the state for educational purposes, for the maintenance of your state roads, to provide some health care, to provide police protection for the citizens. Then there's also the benefits that are being taken out. Most likely from your paycheck, you're having medical, dental, vision, and life insurance taken out. And then finally, the one I'd like to focus on is what you really need to be putting aside for savings. I had mentioned on the previous slide, wanting about a 10 to 15% savings rate for people. 10% would be $150. So if someone is diligently working and doing that, their take-home pay is not $1,500. Their take-home pay is really about 60% of that, or about $900, which is the amount of money that we'll have used to pay our rents, buy our food, buy our clothes, fill up our gas tank, make our car payments, make our insurance payments, go out and enjoy ourselves with various entertainment activities, whether they be sporting events or cultural events in the process. So like I said, expendable income, it's not your gross paycheck, and it's not your take-home pay either. What it really is the definition of the money that you're going to need in retirement, and how those monies are going to be used for paying for things that you need. So what you will be paying for in retirement, much like you're paying out of your current paycheck, you'll be paying for any benefits that you want to continue to have in retirement, such as the medical, dental, vision, life insurance benefit that you might be actively paying for as an active employee. You'll still be owing federal taxes and state taxes on those benefits. The things you won't be paying for in your retirement checks, you'll no longer be paying into Social Security. You'll no longer be paying Medicare taxes anymore, because those are things that are only taken out of active employee paychecks. And you'll no longer have an employer plan to be saving money into. Now, you could certainly have an outside IRA that you could still contribute to on some regular basis. But in terms of a normal employer type plan to be offering and saving money into, you will not have. But you can see from this slide that whether I go from one way or the other, either from the gross paycheck or from your take-home pay, I'm either adding or subtracting the things, getting down to your expendable income. That is the number you are really trying to look at to figure out my 80% benchmark that I mentioned on the previous slide. Now, for saving for retirement, what we're really looking at is the plethora of retirement programs that you have available to you. Most of us have access to Social Security, though some of us in the state of Georgia do not. If you're on the private enterprise, you have a 401k plan. If you're in a school system or any governmental employee, you have access hopefully to a 403b or a 457 program. Don't worry too much about the 401k or 403b or 457. They all refer to basically the same program. They're just different versions of the Internal Revenue Code that define whether they're going towards private enterprises, educational institutions, or governmental institutions. And certainly one of the greatest bits of advice that anybody could give you is that if your employer does provide some type of employer match to these programs, please be sure to take advantage of that free money and contribute enough money to those to at least get the maximum match you can get from your employer. You also may have a company defined benefit plan or a state defined benefit plan, which you may be having access to as well. The majority of us are automatically covered by the Teachers Retirement System of Georgia. Some of us may be covered by the PSERS program or even the Employers Retirement System of Georgia as well. Your individual employers may also have their own defined benefit plan that you can be involved in as well. Outside of your employment, you can certainly set up an individual retirement account to be saving money towards. You may be choosing, as you're raising a family, to contribute to a college savings program. Another good investment thing to help defer when your children get into college, to have tax deferred savings to pay for some of the college costs. You may also have personal investments that you are actively contributing to either through a Charles Schwab or a Vanguard or a Fidelity or an E-Trade or wherever, where you are making your own personal investments to save money ultimately for retirement. I put lottery down there as a question mark. I certainly do not want anybody to get the impression that playing the lottery is a wise retirement investment choice. You can see a great deal of notoriety with people who are interested in playing the Powerball or Mega Millions when they are getting up into the hundreds of millions of dollars in the process. But even if you were to just try to get to the $1 million payout level, to give you an idea of how the odds are stacked against you, if you were to play the Powerball, which is offered 3 times a week, and you put down $20 down for every time you played it, it would take you about 5,000 years to have a 50-50 chance of winning $1 million. And over that period of time, you will have probably paid in roughly about $11 million for that opportunity to have a 50-50 chance of winning $1 million. So it's not a great investment choice. Obviously, some people do win it, but if you're looking for retirement, I would not try to count on that as a primary retirement savings vehicle. Now, I talked about how you can become a self-made millionaire and how I want you to try to become one. And so here's a chart which will show you how much money you need to start saving on a monthly basis if you want to become a millionaire and you turn age 65. So you can see if you start saving religiously when you basically enter the workforce out of college at the age of 25, you only need to be saving about $300 a month on a consistent basis so that when you get to age 65, your account will have accumulated to $1 million. But for every 5 years you wait, it'll cost you another 50 to 60% more to achieve that same $1 million. So if I decide to wait until I'm age 30 to start contributing, I'm going to have to contribute roughly $470 a month to get to that $1 million. If I wait till I'm age 35, it's $710. If I don't start till I'm age 40, I'm now having to save over $1,000 a month. And if I have completely forgotten to do it at all until I reach the age of 50, I'm having to contribute nearly $3,000 a month for the next 15 years to get up to the point where I'm going to have $1 million in savings when I turn age 65. Now, in terms of investing, there's lots of investing tips. The biggest one basically is to diversify. It is impossible to know everything that's going to happen with every single stock that exists out in the universe. And the types of investments that are out there, I've listed on the right-hand side, covers the complete range anywhere from large cap US stocks like a Coca-Cola or a Home Depot, down to small US stocks or international stocks, the very safe treasuries or bonds that are out there, to some more volatile and very identified and focused things such as investing in precious metals, like investing in gold or silver or platinum, or even having the ability to go out there and invest in private equity with firms that are specifically going out and purchasing companies that aren't even listed on the stock market and hoping to grow those and eventually sell those for a profit. So given all of that, like I said, it's impossible to know everything. So you definitely don't want to focus on just one stock. You also want to be sure that you're saving for events, such as saving for retirement, saving to eventually purchase a house, saving to eventually send your children off to college. These are all large expense and large dollar figure needs. And so you need to have a definite plan about how you're going to fund those. You also want to identify your wants versus your needs. I would certainly love to have a Ferrari, but I could probably get away with a Ford. Your children may like to shop at H&M, but they can get similar clothing at Walmart. And though everybody enjoys their occasional eating out, it is much more expensive than necessarily cooking at home. So there are things that you need to decide on what really becomes important to you and what is actually a need to do. Also, only invest what you're willing to lose. Stocks can and will lose money sometimes. Anybody who's been in the market or has seen their 403B plan decrease 15 or 20% in value over the last year, obviously has to realize and be comfortable that that type of volatility may exist. You have to plan for it, but also know that in the long run, stocks generally increase in value. And then finally, boring is best. What you want to do is you want to work with a financial advisor, create a plan, monitor that plan on a regular basis, not a daily basis, not even a monthly basis, but probably an annual basis. And be sure you stick to your plan. Don't necessarily get intrigued or incentivized to jump on the next Bitcoin type offering that might be out there in the process, because you could get a lot of money or you could lose all of your money, going back to only invest what you're willing to lose. Now, to start talking about the individual plans that are available to you, we'll start with Social Security. Obviously, it's one of the longest running programs that's been out there. It was established in 1935 by Franklin Delano Roosevelt. It was designed to protect against poverty. So it wasn't really solely a retirement program. And to quote exactly what Franklin Roosevelt said when he signed it, and I quote, "We can never insure 100% of the population against 100% of the hazards of life. But they've tried to frame a law which will give some measure of protection to the average citizen and to his family against the loss of a job and against poverty-ridden old age." So what Social Security was never intended to be anything more than a poverty protection program, not somebody's sole source of income. And as you can see by the graph I've got below, you can see that it does pay more for those people who make less, hence the social aspect of it. At the same time, it does not in any way replace that 80% benchmark that I was looking at, and hoping that everybody can kind of aspire to get towards in retirement. So you can't use this as your sole source and hope to have the same standard of living in the process. The other things that people do have access to, obviously, is the public school employees retirement system. This was established by the Georgia General Assembly in 1970. It is not a retirement plan. It is a supplemental plan and was basically instituted and created to provide those people who are involved in that program money so basically they could continue on with their health insurance coverage payments in retirement. It is unlike the teacher's retirement system, which is a retirement benefit to Congress. That one's obviously been around. Actually, now it's entering its 80th year in the process. So it is a very well-managed, well-financed retirement system for all of us who are covered under it in the process. It will pay you 2% of your pay for every year of service that you have in the system. And it can provide, obviously, for people who work a 30 or 40-year career, it by itself is going to provide a benefit that will replace 60 to 80% of your salary. Now, though many of you are probably not covered by PSERS, many of you probably supervise people who are covered by PSERS. And most people who are covered by PSERS will always complain that what an awful benefit it is. And I agree to a point that it is an awful benefit in the terms of the amount of money that it provides. But in terms of the return on their investment that it provides, it is absolutely a fantastic benefit. It's actually more beneficial than the teacher's retirement system. Meaning that for someone who paid or into the system for 20 years, they've only paid $1,800 into the system over the course of that entire career. Yet their annual retirement benefit is going to be over $3,800 a year coming out. And that return on contributions is over 26% annualized. And even if you work a 40-year career, and I apologize, that annual retirement benefit of $680 is actually $8,680. It actually is a 12% return on your investment, and that's basically a guaranteed investment return. The state or the employer is contributing 75 to 90% of the value of the benefit for PSERS. So if you do hear people complain about PSERS, remind them that what they get out of it is fantastic for what they're having to pay into it. It's just that they're only paying $36 or $90 a month for that benefit. Now, to kind of compare the plans of what's out there, I talked about Social Security. This is your base level of coverage. It should replace roughly 40 to 60% of your salary after a full career. You are contributing 6.2% of pay. It's basically paying you back about 1.4% of your pay. There is vesting required on it, usually 40 credits, or basically 10 years of paying into the system. And you have availability to start receiving that benefit as early as your age 62. The PSERS benefit, as I mentioned, it is a supplemental benefit. At best, it will replace about 25% of your salary at retirement. As I mentioned, small contribution levels, only $36 or $90 a year going in, $192 a year benefits. You become vested after 10 years. That benefit can be received as early as age 60. And then for most of us, the teacher's retirement system benefit, which would be our primary source of retirement income. Over the course of a full career, it is going to pay 60 to 80% of your salary. So you're contributing 6% to it. That is legislated by pay or legislated by the Senate. The retirement benefit itself is 2% of your pay. You are guaranteed a benefit once you have spent 10 years in the system. And once you have worked 25 years in the system, you are eligible to leave the system and start receiving your benefits immediately. It is called early retirement because you have not worked a full 30-year career or possibly have not reached the age of 60. But it is a retirement availability for everybody that's covered by that system. And then the final savings programs I wanted to talk about are your defined contribution programs. So for those, the most common one that's always referred to is a 401k. Those are for your private businesses such as Coke and Home Depot. A 403b program, which is for educational institutions, and a 457 program, which is for governmental institutions. Now, for most school districts that are out there, they have the benefit of being considered educational and governmental. So they do have access to both of them if your employer decides to offer both of them. And then outside of your employment, there are individual retirement accounts or IRAs that you can also contribute to. So for the amount of money that you're deciding to save into one of these retirement programs, what type of return or what type of benefit can you expect to get from them? And so depending on what your savings rate is, and for these examples, I've chosen 3%, 5%, or 10%. If you are diligently saving those amounts out of your paycheck over the course of your career, this is what type of replacement percentage you can expect to get of your retirement salary at there. So if you're only going to assume a 4% return on your investment, for every percent that you save, you can expect to get about 2.5 times that amount in retirement as a percentage. If you were to expect a more reasonable long-term investment rate of 6%, you'd be getting basically roughly a 4% or a 4 times return. So if I invest 5% of my salary, then I'm going to get annuity benefits that'll be 20% of my salary. And then finally, if you're all the way and do an extremely good investing job and get an 8% return on your investment, you're looking somewhere in the neighborhood of 5 to 6 times the amount you invested getting back as a retirement benefit. So this can help you kind of guide along with the other programs that you're involved in to help you determine how much money you should be saving depending on what your desired result is. When you combine these percentages to the percentage you'll be getting from Social Security, the percentage you'll be getting from a teacher's retirement system or a PSERS benefit or your own company's defined benefit plan, this can help you build up to the part and fill in that gap to get to that 80% or greater ultimate replacement that I would like for everybody to be at in the process. It's also very, very valuable to keep in mind that what you're saving into a defined contribution plan is a pot of money that's available for you at retirement. And it's much different than a paycheck or a benefit that's coming to you from Social Security or from the teacher's retirement system. Those benefits operate very much like your paycheck. You can't get an advance on them. You can't defer them until a later point in time. They're going to be coming to you regularly on a monthly basis. Where the defined contribution becomes very, very important, that pot of money, is because it allows you to access or not access money as needed in retirement. So if you have a $5,000 medical bill that comes up and you need emergency money, you can access your defined contribution plan for that full amount, whereas you would not be able to do that with your other benefits. Similarly, if you did not need that money, you could defer it and not take anything out and let it grow out into the future until some later point in time where you may feel the need to have it. Also, something you cannot do with the other benefits that will be coming to you. So it is nice for financial planning to be sure you have a mixture of both guaranteed benefits that are coming to you and flexible benefits that you can access as needed. Now, for some of the retirement savings programs, one of the good things about employer programs versus an individual IRA is just the amount of money that you can contribute to them. Not that many people get to those higher amounts, but it is nice to know that it's about 3 times the amount that you can save if you want to in an employer plan versus an employee plan. It's also nice to know that for those of us that are with a company that offers both a 403B and a 457 plan, that those limits are basically doubled. So for those people who are members of school systems, can potentially defer over $50,000 a year into a retirement program if they had the desire to do so. The other information about defined contribution plans is about how, which type of program you get into. And there are 2 main programs with retirement savings programs, and those are the traditional plan or what's called the Roth plan. And basically what it comes down to is, do I pay my taxes now or do I pay my taxes later? And to how much income am I paying those taxes on? So you'll notice from the graph below, your contributions will get taxed either before you make them or once you start drawing them out, depending on whether you go with the Roth version or the traditional version. On the Roth version, you're paying your taxes up front and making your contributions, and you're not being taxed on them when you start taking them out in retirement. In the traditional plan, you're deferring those taxes, not being taxed on them currently, but will be taxed on them once you start drawing them out. The biggest difference between the two is what I've highlighted is what you're doing and how you're being taxed on your investment earnings. On your Roth plans, all of the investment growth in those, you can pull out and not be taxed on them at all. So if you have a very, very long horizon of investment, it may be something worth considering so that all that investment growth will not be taxed. In the traditional sense, those investment earnings will be taxed when you start taking them out in retirement. So the question basically becomes, 1, do you think you'll be in a higher or lower tax bracket in retirement? And 2, how much investment earnings do you think you're going to accumulate and whether you would like those monies to be taxed or not? With a defined contribution program, it's also important to note there are some penalties upon withdrawal. If you pull your money out prior to age 59 and a half, there is a 10% tax penalty associated with it. So if I am withdrawing $1,000, I will be paying tax on that $1,000. Plus, I'll be paying an additional $100 penalty if I pull that money out prior to age 59 and a half. However, in my 457 program, that penalty does not exist in the process. And after people reach age 59 and a half, there are no additional withdrawal penalties. So once again, from a planning perspective, for those of you who may reach a retirement age before age 59 and a half, to the extent you have the ability to be in a 457 program, it may be beneficial because you'll be able to pull that money out without any additional penalties in that process. Once you turn age 59 and a half, they're all identical, and you could feel free to pull from any one of the programs you have without any adverse consequences. So that was kind of a brief and quick run through financial security. Basically, to summarize, hopefully, I want you to know, what you want to get to, and hopefully you want to get to that 80% level or greater. Why don't you know what you've got? You can figure out what you've got from Social Security, what you're going to get from your own employer, what you're going to get from the teacher's retirement system. And then with those 2 pieces of information, hopefully you'll know how to fill the gap to get from what you're guaranteed to what you ultimately want to get to. So that is a quick run through financial security. I am available to answer any questions that might be out there. And as Karen said, any questions that we don't get to today, I will certainly answer them and get them back to Karen to then distribute back out to the membership.
There's a couple questions over here, David. The first one, someone wants to know if Gwinnett County Public Schools has employer match.
Gwinnett County Public Schools does not have employer match. What Gwinnett County Public Schools has instead, we are one of the counties that does not pay into Social Security. So we have a defined benefit plan, which serves as an alternative to Social Security. It is fully funded by the school system, and because the school system is funding that benefit, they are not offering any matching contributions to their 403B or 457.
Okay, and then someone wants to know if you can talk about the windfall rule with Social Security.
Sure. Within Social Security, there is a provision called the windfall elimination provision, which basically means for those of us who will be receiving a benefit for which we did not pay into Social Security for. So for people in Gwinnett County Public Schools, it's the Gwinnett County Public Schools benefit and also the teacher's retirement system benefit. For other school districts, it may just be the Social Security, the teacher's retirement system benefit. What Social Security will do is they will offset any Social Security benefit you are entitled to by some portion of that other benefit. It will not completely eliminate it. So it's definitely beneficial to get, you'll always get at least some Social Security. If you've paid into Social Security for 30 years, there's no reduction. If you've paid into Social Security less than that 30 years, there is about roughly a $55 a month offset for every year you were short of 30, up to a maximum of about a $550 reduction. So if you go out to the Social Security website and you look at your own benefit statements, it does not include the windfall elimination provision, but if you think you're going to be affected by it, you can take the amount that Social Security says you're going to get and at a maximum subtract $550 off of it, and that'll be a better reflection of what you truly should expect to get from Social Security.
Okay, I don't see any other questions. Oh, let's see here. David, do you have any suggestions for someone who paid into Social Security years ago, but not within the 5 of the last 10 years of retirement? Would you still qualify for Social Security?
As long as you've got 40 credits or basically 10 years of paying into Social Security, you are entitled to a benefit from that. So even if you haven't paid into Social Security for the last 20 or 30 years, you'd still be entitled to a benefit from them. I'm probably going to get I'll get some of my Gwinnett County people upset at me, but I'll go ahead and say this anyway. If you are working in a system that does not pay into Social Security and you are covered under the teacher's retirement system, it is actually beneficial for you to spend your last 5 years of employment working in a county that pays into Social Security, because then your teacher's retirement system benefit will not count as an offset in the windfall elimination provision. Not that I want a bunch of people jumping around from county to county, but for those counties that pay into Social Security, that's probably something they should promote to people who are later on in their career, that is a way to avoid the windfall elimination provision.
No, that's very good information. I think those are all the questions for now. I do just want to reiterate what Alicia had put in the chat, that this session is being recorded and it will be posted on the newly created webinar platform, which will be on the GSNA website, and it will be posted soon. And on behalf of our GSNA president, Alicia Wright, David, we thank you for being on this webinar and making such a complicated and sometimes daunting topic seem easy to understand. And we can always reference back to this in the future. So we appreciate it and thank you very much.
Oh, it's my pleasure.